Tilray Brands may sell its shares, but don't let this deter you from buying Tilray stock. Tilray Brands is growing its revenue rapidly and narrowing its profitability gap. Furthermore, Tilray might sell many of its shares, but the funds could be used to acquire assets. Investors should think about owning a small position in Tilray stock. Let's dive in. Is Tilray stock your ticket to the coming U.S. cannabis gold rush? Welcome to Timely Investment Research. Cannabis and related products seller Tilray Brands is headquartered in Canada. However, the company seeks to expand its presence in the U.S. when cannabis is legally rescheduled there. In anticipation of this, investors should buy Tilray stock before the U.S. canna boom starts. Recently, the U.S. Department of Justice under the Biden administration proposed to legally reclassify cannabis. That's a major potential catalyst, but as we'll discuss in a moment, Tilray is already showing remarkable financial progress. So there's no need to wait for marijuana law reform to start a small Tilray share position. Tilray's excellent financial improvement. There are a couple of reasons not to overinvest in Tilray stock. First, it's unclear if cannabis will be legally reclassified in the U.S. Second, Tilray is still an unprofitable business. Yet, while Tilray isn't perfect, the company is improving. In the third quarter of fiscal 2024, Tilray narrowed its net earnings loss to $105 million, 12 cents per share, versus $1.2 billion, $1.90 per share in the year-earlier quarter. This bottom-line improvement was made possible, in part, by Tilray's impressive revenue growth. Specifically, Tilray grew its net revenue by roughly 30% year-over-year to $188.3 million. An evident highlight of third quarter fiscal year 2024 was Tilray's sales growth in the company's beverage alcohol segment. Tilray managed to increase its beverage alcohol revenue by 165% year-over-year to $54.7 million. This growth was driven, in part, by Tilray's new craft acquisition brands. Don't fret over Tilray's possible share sale announcement. As I alluded to earlier, Tilray seeks to position itself to capitalize on potential U.S. cannabis law changes. However, Tilray's U.S. build-out won't happen without near-term capital outlays. As the old saying goes, it costs money to make money. Investors shouldn't worry too much about Tilray's announcement that the company might sell up to $250 million worth of its shares via an at-the-market equity program. For one thing, it's not guaranteed that Tilray will actually sell $250 million worth of the company's shares. Also, Tilray doesn't plan to use the share sale net proceeds for general working capital purposes. Rather, Tilray would use the proceeds to fund strategic and accretive acquisitions or investments in businesses. These could include potential acquisitions of assets in the U.S. and internationally in order to capitalize on expected regulatory advancements or expansion opportunities. So, Tilray may end up selling its shares in the coming months in order to generate more long-term revenue in the U.S. and abroad. Therefore, I encourage nervous investors to think about the big picture instead of worrying right now about Tilray's ATM equity program. Ready for the U.S. canna boom? Buy Tilray stock. There's no guarantee that U.S. cannabis law changes are coming soon. However, with or without those changes, Tilray is already showing excellent improvement in the company's financials. It won't be a huge problem if Tilray ends up selling its shares. This could help the company capitalize on opportunities in the U.S. and elsewhere. Hence, investors ought to consider taking a small but confident position in Tilray stock today. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.